Hello, everyone. My name is Oleg Kagan, and I'm the Community Engagement Coordinator with LA County Library, and I welcome you to Work Ready, Understanding Benefits Beyond Salary. Before we get going with today's event, I will do the land acknowledgement, take care of some housekeeping, and tell you a little bit about the Work Ready program. So first, the land acknowledgement. The County of Los Angeles recognizes that we occupy land originally and still inhabited and cared for by the Tongva, Tataviam, Serrano, Kich, and Chumash peoples. We honor and pay respects to their elders and descendants, past, present, and emerging, as they continue their stewardship of these lands and waters. We acknowledge that settler colonization resulted in land seizure, disease, subjugation, slavery, relocation, broken promises, genocide, and multi-generational trauma. This acknowledgement demonstrates our responsibility and commitment to truth, healing, and reconciliation, and to elevating the stories, culture, and community of the original inhabitants of Los Angeles County. We are grateful to have the opportunity to live and work on these ancestral lands. We are dedicated to growing and sustaining relationships with Native peoples and local tribal governments, including, in no particular order, the Fernandino Tataviam Band of Mission Indians, the Gabrielino Tongva Indians of California Tribal Council, the Gabrielino Band of Mission Indians, Kich Nation, San Manuel Band of Mission Indians, and the San Fernando Band of Mission Indians. To learn more about the First Peoples of Los Angeles County, please visit the Los Angeles City County Native American Indian Commission website at lanic.lacounty.gov. I'm going to put that in the chat as well. All right. Now let's do the tech check. If you can hear me and see the slide up on the screen, then you're good to go. However, if you're having trouble hearing me or seeing the slide on the screen, let me know in the chat and I'll do my best to assist. If you'd like to listen to this presentation on the phone, you can do that by calling 1-669-900-6833 and using the passcode 840-6824-3369, and that's the access code, and the passcode 123123. Now, you may have noticed that the mics and videos for attendees of this program have been disabled, and that is so that everyone can focus on our presenter for the day. We do, however, welcome your questions and comments. Questions should go into the Q&A box and comments should go into the chat. The Q&A box is the one with the two little speech bubbles. And you should put your questions there because that way we won't miss them. In the chat, when it moves fast, it's easy to miss questions, and we don't want to miss your questions. Speaking of questions for today's presentation, if you would avoid putting personally identifiable information or very specific scenarios into the questions, this presentation is intended to be a general primer on benefits beyond salary, and we're going to be unable to give very specific advice since, of course, every situation is very different and we value your privacy. All right. And now I'd like to tell you about the Work Ready program. Work Ready started in December of 2020 with the purpose of helping people get a job, improve their work situation, and plan a more sustainable career path. We do that in two ways. One is we lend out laptops and hotspots for 6-week loans out of 27 library locations, breaking down one barrier to applying for jobs and getting online training. And number two is we provide virtual events just like this one on a range of work-related topics, from basics like resumes, cover letters, interviews, to deep dives into various careers and other subjects to help you succeed at work and even beyond work, like benefits. And if you'd like to see those past programs, we have over 50 of those past classes that you can check out at any time on our work and career playlist on our YouTube channel. I'm going to post a link to that in the chat, and you can look at those, watch parts of them, or share them with people who you think would benefit. And the Work Ready program is, of course, made possible due to funds provided by the American Rescue Plan. Now, before we get into today's program, I also would like to let you know what we have coming up next week, and that is Work Ready, the 7 keys to connecting. Are you scared to network? Go from awkward to awesome with this masterclass led by career coach Liz Moeller. Come learn to truly connect with people to expand your reach, how to select events that work for you, and other nifty networking tips. That's next week, July 2nd at 11 a.m. And as a fun note, that's going to be our 100th Work Ready program. We've been doing this for a little while. And so we've racked up 100 events, and we hope that you join us for 7 keys to connecting. I put the registration link in the chat. And of course, it, like all of our programs, are absolutely free. If you're going to be interested in more events, you can go to our website at lacountylibrary.org, click the events button. That's going to take you to all the events, in person and virtual. And you click on those events and you'll see events for all ages, kids, teens, adults, older adults. And if you're just interested in virtual events, then you will want to hover over that button and you're going to get a little drop down. It says virtual program. You click on that and then you'll get all the zoo events like this one. Also, all ages, also absolutely free. Okay, introduction complete and time to move on to today's program. And to do that, I'm going to introduce our speaker for the day. Tiffany Dyson is a graduate of Dartmouth College, where she studied sociology and Hispanic studies and played on the varsity softball team. For the past 6 years, she has worked for an investment firm where she delivers business building, execution, and training to investment and financial professionals. She trains financial advisors on growing their business using LinkedIn and supports their clients with education on job seeking, networking, and financial literacy. An LA County native and current resident of West Hollywood, she connects with the community through membership in Toastmasters and volunteering with Reading Partners, the Girl Scouts, and she has recently become the president of the Dartmouth Club of Los Angeles. Her interests and passions include being active outdoors and helping people improve their confidence with personal finance and professional development skills. With that introduction, I bring to the stage Tiffany Dyson. Tiffany, the stage is yours.
Thank you so much, Oleg. I truly appreciate the introduction and the sneak peek into next week's Work Ready program. I think networking is so important, and as we go into the 4th of July weekend, it'll be nice to put those into play. Exactly. So thank you everyone for taking time out of your busy schedules to be with us today. As he mentioned, my name is Tiffany Dyson. I am an LA, Southern California native. I am a certified financial education instructor, and I'm always so excited to partner with the LA County Library on topics near and dear to my heart. So after working in corporate America and financial services, after never taking a formal finance class outside of the basic Econ 1, I realized just how undereducated we are about personal finance. So I've made it part of my mission to share as many economic empowerment resources as possible with the hopes of helping people feel more confident with their finances. So today we'll talk about understanding our benefits and beyond the salary. But wanted to start by acknowledging that when it comes to financial planning, there are many, many more components than we have time for just today. So I want to acknowledge that, many attendees on the call may be at different stages of figuring all of this out. But the important thing is that you're here, you're listening, and you're learning. So you might be working on budgeting, tracking your income and expenses. You may be learning how to make passive income with investing or how to save money on taxes. Or you might even be at the stage where you're planning your estate so that your assets and money go exactly where you want when you pass away. Now, that's just a brief acknowledgement. And before we really get into our conversation, I always like to remind people the first step in achieving financial security is building out an emergency fund. Now, this is the money you set aside to use on unexpected expenses or bills. Let's say you get a flat tire on the way to work, you have an unexpected hospital visit, or even in the case you lose your job. This emergency fund can help soften the blow. In a recent bank rate survey, they actually found that 59%, almost 60% of US adults are uncomfortable with their emergency savings, and 1 in 4 do not have an emergency fund at all. I know that won't be any of you after this conversation, but again, it's just really imperative that we focus on this first step. Experts like to think that 3 to 6 months of fixed expenses is helpful to have saved in your emergency fund. Now that might be a lot of money to think about. So if that's not readily doable just yet, the point is to start small, save $5, $10, $20 per paycheck. And that's really so that you have these emergency reserves so that you can put those emergency costs pull them from the fund instead of putting them on your credit card or dipping into your other savings. So I always think that is just important to lay some groundwork. But really where we're going to start the conversation today is looking at an overview of different benefits that companies offer outside of an employee's salary or paycheck. Now, the second part of the presentation will be focused on retirement account options. So paycheck, hopefully everyone knows exactly what that is. Now, an employee may receive an annual salary, which is what they know they'll earn in a given year. You might be an hourly worker, so your annual earnings are based on how many hours you work. Some employees may receive bonuses, which is different than the salary, but does obviously count toward your overall compensation. And then there are additional perks or rewards in the form of workplace benefits. So some of the common workplace perks are seen on the screen here. Your current or future employer may offer some, all, or none of these, but it's important to understand what they offer and how we can take these additional advantages in the workplace. So we'll go over all of these in greater detail, but I want to highlight a key term that you may have heard throughout the work year, and that's annual or open enrollment. And this is the period of time, generally about a month out of the year, where employees may make changes to benefit options. Now, for example, why would you change your benefits? Well, if someone is now trying to start a family, they may change their health insurance to have better coverage. Or if someone recently learned they need glasses, they may opt in to vision coverage. Now, there is one exception to making changes to benefits outside of that open enrollment period, and that's if you're experiencing a qualifying life event. These life events are marriages, births, adoptions, the death of a spouse or partner who previously covered your insurance, or even if you're a young adult, losing coverage from your parents' insurance. So as an example, many insurance companies will cover a child or dependent until they turn age 26. So just a few years ago, when I turned 26 in February, I was able to gain coverage from my employer's insurance option outside of the normal November enrollment. So luckily, they do account for those life events because obviously things do change throughout the course of the year. But you would want to check with your employer for the specific time frame of your open enrollment period and whether you're going through any qualifying life events. So one of the most appealing and maybe most well-known benefit in the workplace is health insurance. Employer health insurance can cover some costs of preventative care, hospitalizations, outpatient services, and prescriptions. Now, generally, you have multiple options of health insurance to choose from. There are a few different, but two common categories are HMOs and PPOs. HMOs stands for Health Maintenance Organizations, and PPOs stand for Preferred Provider Organizations. A general rule of thumb to remember the distinction: preferred provider of PPO means you have more flexibility to choose providers in or out of network. Now, with that flexibility, there does tend to come a higher cost. So you would want to work with your HR department and really reflect on your specific situation to learn about your options and figure out which makes more sense to you. Another good rule of thumb is that typically if you're paying higher premiums, so a higher monthly cost, then you'll have lower out-of-pocket costs when you actually go to the doctor, and vice versa. If you're paying lower premiums per month, you may have higher costs when you do actually go to the hospital or the doctors. Now, other medical coverage includes dental, vision, mental health, and EAP, which stands for Employee Assistance Programs. Now, some other key terms to understand with health insurance, and I've already previewed a couple. The first is premium. That is the monthly payment you make to have health insurance coverage. A deductible. That is the amount you must pay out of pocket for covered services before your insurance kicks in and starts paying. It's almost a minimum amount that you have to spend. A copay, if you've been to the doctor's office, I'm sure you're familiar with this. That's a fixed dollar amount you typically pay for certain covered services like doctor visits. And at times that will persist even if you've hit your deductible. Now, coinsurance, that's a percentage of the cost you share with the insurance company for services once you meet your deductible. And then fortunately, there is an out-of-pocket maximum. So we don't have to, keep going to the bank or writing the checks. It is exactly what it sounds like. It's the maximum amount you have to pay out of pocket for covered services in a year. So with all of that in mind, and I know it is a lot of information, so I appreciate your patience. Sometimes it's good that I can't see your videos because then I see some concerned faces. But now we're going to look at how valuable an employer-sponsored health plan can be in terms of costs. Now, if you have friends or family who pay for their own insurance, or they don't have coverage at all, you may be familiar with horror stories about the high cost of healthcare in America. Now, we're going to look at our example worker, Drew, to illustrate the benefit. So on the left side of the screen here, you can see how an employer-sponsored plan compares to an individual marketplace plan. Now, because of the employer contribution, Drew's annual cost is much cheaper than if he was to pay for it in full in an individual marketplace plan. So it's over $3,000 cheaper. Now, the savings don't stop there, though. If Drew has a medical emergency like surgery, the cost without insurance could be $10,000, maybe even higher. Now, the same emergency with insurance results in an out-of-pocket cost being a fraction of that $10,000 total. So you can see he's got his $2,000 deductible, which he pays up front. Let's say he has this accident in January, so he hasn't been to the doctors at all, so he'll pay that in full. The health insurance coverage is 80% after the deductible. So $10,000 minus $2,000 deductible, $8,000, 80% of that, $6,400. And then the remaining co-insurance of 20% is about $1,280. So you can see, again, just a fraction of what the out-of-pocket would have been without insurance. This is a hypothetical situation, but really illustrates the cost savings, some of the protection, and really the convenience as well. Now, the next benefit we'll review adds wellness into the mix. So we've got health and wellness. Companies may offer programs and incentives focused on helping employees improve their fitness, nutrition, finances, work-life balance, and more. So I'm sure many of you have experienced that after the pandemic, a lot of companies are offering flexible work arrangements, such as hybrid models. So employees may only be required to be in the office 3 or 4 times a week. That can help with work-life balance, help with childcare, of course. Now, some companies even partner with third parties to create incentive programs around wellness. As one example, Virgin Pulse is an employee wellness tool that employees can track their sleep, their steps, physical activity, and other good habits to earn actual money. So with this app in particular, when you earn more points, you get closer to receiving $50 per quarter in gift cards. So if you do, if you hit your maximum at each quarter, there'd be an extra $200 per year just for tracking your healthy habits. So keeping you well and healthy also means giving you time to decompress. It gives you time off, which is also known as PTO, paid time off. Employers know that paid time off is critical to enjoy our hobbies, our loved ones, to recharge mentally and physically. It really helps avoid burnout and stay motivated or engaged with your work. So if you have access to this, I highly encourage you take your time. Now, the first step would be to check your company's PTO policy. Many companies have a system where employees accrue or add PTO depending on how long they've worked for the company. So if you're a new employee, you may have to wait until you accrue or add up enough days to take off. Now, there are three important considerations to keep in mind. The first, typically you can't use more PTO than you have accrued, which makes sense. But what about that example of an employee who was recently hired? Now, I've heard of folks who join a company in the summer months and have already planned their European or Hawaii vacation. Now, in some instances, you can work with your new employer in the event that you don't have enough PTO to cover a planned vacation. You can be upfront with that to learn more about how that may work once you're hired. And the second consideration would be that some companies may have PTO caps, so ceiling. So once you reach the cap, they may stop, accruing hours until you use some, or maybe you've accrued for the entire year. And then lastly, which might be most important because it gets you more time off, that's to check your carryover policy. So some companies allow employees to carry over unused PTO to the next year. So maybe you have 5 extra days at the end of December, you haven't used them yet, and you can add them to the next year so that you can take even more time off in that year. Now, I'd be careful making sure that you check whether this applies at your company, because if not, if you don't use it, you lose it. So again, your PTO is well-deserved and for your well-being. So if you take one thing away from this presentation, honestly, I hope that it's to use your time away to rest and recharge. Now, the next benefit to keep in mind is important, especially if you're looking for a promotion or to advance your career. And this is professional development with a number of ways that you can do that. One big piece of career advice I received that I want to kind of shout from the rooftops is that if you're asking for a promotion or a raise, always have a few more asks ready to respond with. So when you're asking your manager, first and foremost, your top priority is a raise. But if they say now's not the right time, you have other options or other asks to turn to. So why would we do that? Well, again, if they say that they can't give you a promotion just yet, you might respond asking them to sponsor your attendance at an upcoming industry conference. Or you may ask them to sponsor your upskill training, such as a certification or a course that's relevant to your work responsibilities. Now, in fact, especially when it comes to courses, many companies offer tuition reimbursement or professional development stipends. So with tuition reimbursement, that might be at maybe a graduate degree level, certainly part-time, so you can keep working for the company. But companies will cover a certain percentage of a course, or they may cover up to a certain amount each year. For example, my previous company would reimburse people $7,000 each year for tuition. And there were a couple considerations. First, the coursework or the degree or the certification had to be relevant to your current job. And you had to be employed for over 1 year. But both of those things are easy to check off, and $7,000 is a really great opportunity for you to advance your career, acquire new skills. And even though it's not necessarily in your paycheck or in your salary, that's $7,000 that don't have to come out of your pocket. So really encourage you to look into that and whether that's available for you to level up. But what about the tuition that a lot of us have already paid for? Now, that would be around student loans. Student loan repayment assistance is a growing trend in employee benefits. And the reason is very good. On average, the federal student loan debt balance per person is almost over $37,000. So obviously affecting a lot of people and affecting a good chunk of our financial health. So this assistance can take many forms that you can see on the slide. Companies might contribute a fixed amount. They might match your payments up to a certain amount. One thing to note that can be very powerful, if you work in public service, such as government, in a nonprofit, maybe you're working at AmeriCorps, you may be eligible for loan forgiveness after 10 years of full-time work. This combines a very specific number of factors, but it is really an amazing opportunity for public service loan forgiveness. You would want to consult with your employer first and foremost and do research on the Department of Education website for more information and to really figure out whether you qualify. Now, for all student loan repayment assistance, it's important to understand the specifics of your company's program, including the contribution amounts, the eligibility criteria, and any tax implications. It might even be worth a conversation with a financial professional to discuss your specific student loan situation and how it fits into your overall financial plan. And while we're on the topic of financial plan, we'll wrap up this first section with a brief introduction to additional savings accounts your employer may offer. These two are in addition to the retirement plan offerings that we'll cover in the next section. They're called the FSA and the HSA. FSA is the flexible spending account, and the HSA is the health savings account. Now, these are not available to everyone, so certainly you'll want to check about eligibility and whether your company offers them. But if they're available to you, they're excellent ways to save extra money and take advantage of tax benefits and potential company matches. So to zero in on an example with the HSA, the health savings account, this is available for workers who are enrolled in health insurance from a high deductible health plan. That usually offers a lower monthly premium, but higher deductible, hence high deductible health plan than traditional health insurance plans. So even if it is an option, it may not, again, make sense for your specific situation. And the maximum contribution limit for an individual HSA is $4,150 for 2024. And if you have family coverage, $8,300. And that changes year by year. So last year it was less, next year you may be able to save even more. And the reason I get so excited about the HSA is because it is very unique. It's triple tax advantaged. Now, what does that mean? It's a good thing. That's the main point. But triple tax advantage. We're gonna walk through the three tax advantages. The first is you use tax deductible contributions with pre-tax money. So your taxable income goes down, meaning you pay less when you do your annual taxes. Now, I mentioned earlier that when I turned 26 in that same year, I had to get off of my parents' health insurance and enroll in my employer's high deductible health plan. With that, I became eligible to contribute to an HSA. So once that happened, I started contributing about $100 per pay period to the HSA. Now, that money, I never saw. It went directly into the account. I never saw it in my paycheck. So it was a nice automatic way to start saving. Now, by the end of the year, I had contributed about $1,500 less than the maximum contribution limit. I was new. I wasn't sure, exactly what to do, but I contributed less. And what's great is that you can actually make a one-time lump sum contribution before the tax deadline. And I didn't know this before. I was emailed a reminder from the bank managing my account. So I went ahead and I contributed the difference between what I had contributed and what the maximum limit was. Now, when I filed my taxes in April, I went ahead and entered that amount of the lump sum into TurboTax, and I received a pretty significant tax refund. And I was a little surprised, but then it started, the puzzle pieces started falling into place. I started to understand, because I had paid taxes on the money that I retroactively contributed to my HSA, I received the tax refund because I shouldn't have paid taxes on that money in the first place, since it's going into my tax advantaged HSA account. So it was really cool. It was one of the first times I got to experience tax deductions play out in real time, and of course I always want to share that with others. So now that I've learned more about the HSA, I contribute enough per month to hit those maximum limits by the end of the year. That's the first tax advantage. The second tax advantage is that you get tax-free growth on your investments in the account. So once you have a certain amount of money in your HSA, you can begin to invest the excess after the minimum. So when you invest in that account, the interest and the earnings are not taxed, which is pretty rare. And the third of the triple tax advantage is that you have tax-free withdrawals on qualified medical expenses, like your deductibles, your copays, and more. There are very few opportunities for us to contribute tax-free, grow tax-free, and withdraw tax-free. So this is a really excellent savings account to take advantage if it applies to you. Now, I hope you're excited about saving money, as excited as I am. But so we're not done there. Next, we're going to talk about how we can save money in retirement accounts to better prepare us for our golden years. Now, we are going over a lot of information today, so hopefully you're excited about the additional benefits your employer may offer you, but it is very natural to feel overwhelmed as well. So if that is the case, I encourage you to review your benefits offering through maybe your company portal, talk to your HR department to learn more about what's, again, most relevant to you. And as we get into more complicated information around retirement accounts, I'd encourage you to consult with a financial professional or learn more online from trusted resources. So with all of that in mind, I think it's important to note the benefits, no pun intended, the benefits of early financial planning. You know, I think when we put pen to paper and put a financial plan in place, we're more likely to reach our financial goals. We build good habits, we prepare for emergencies, and we use time to grow our wealth. Now, nobody, unless any of you do, and you have to let me know, nobody has a crystal ball to predict what their retirement will look like. But over the years, we've come to know the fact that retirement and life in general is expensive. Healthcare costs are rising in general, and as we age, we spend more money on our health. Now, with these rising costs, it's probable that Social Security will not be enough to fund our retirement alone. And one of the most common questions I hear from people is, how much money will I need in retirement? And again, I wish I had that crystal ball, but it is different for everyone. It depends on what you want your retirement to look like. I worked with a financial advisor once who answered this question by asking the group, and I'll ask you to envision it yourself. When you think about your retirement, what shoes are you wearing? What shoes? Kind of a funny question. But are you wearing sandals and you're at a beachside resort? You're wearing hiking boots because you're traveling all over? Are you wearing your home slippers because you never want to leave the house? Or are you wearing high heels because you're going to a lot of fancy dinners? Now, that's really to help give you an idea on what your lifestyle and expenses might look like in retirement. But ultimately, it's better to prepare and better to be over prepared, especially since the golden years should be completely focused on resting, recharging, and really enjoying life. The reason it's important to prepare as soon as possible is because you may be losing out on investment earnings if you're not invested in the market. So here on the screen, this example shows the benefits of investing early. Some people say the best day to start investing was yesterday. The second best day is today. But the main point is to start as soon as you can. Hopefully you've got, again, your emergency funds, tucked away, readily available to you so that you can have this excess capital to invest and make work for you. But on the screen, we have 3 hypothetical investors who invest $5,500 each year. they all receive an 8% annual return for a 10-year period. Now, this assumed average annual return of 8%. This is a hypothetical example, but for your reference, the S&P 500 index, which includes 500 largest publicly traded companies, returned an average of 12.39% from 2013 to 2023. And even though that was a significant bull run, it has also returned an overall average annual return of 10%. So 8% hypothetical is not too far off. And ideally, every single person on this call will be like investor C in yellow. They began investing right out of college at age 23. And even though they stopped, they never stopped. They stopped when they retired at 65. And as you can see, they had almost $2 million by retirement. Now, you can also see that our investor A in pink began investing right out of college. Even though they stopped at age 32, they earned more by retirement than investor B in purple because they had time in the market and started taking advantage of what's called compounding interest. Even though investor B in purple invested longer, more years. So again, the reason for this is compounding interest, which is what Einstein actually called the eighth wonder of the world. So to talk a little bit more about compound interest and the power behind it, when we invest, interest is the extra money we earn for letting the bank or company use our money. And this is very simplified. But compound interest is often referred to as interest on interest because it's the magic of earning interest, not just on your initial investment, your principal, but also on the accumulated interest from previous periods. Now, I know this can be a complicated and definitely an abstract topic, but let me see if this helps. It's your money, making money, and then the money your money makes is making money. So it, again, is a really, really big driving force into long-term investing strategy. Now, on the right-hand side of the screen here, you can see an example on the top, over 30-year period ending in 2022. If you keep your money in cash or under your mattress, your $10,000 will be $10,000 after 30 years. And if you know anything about inflation or the time value of money, which says that money loses its value, technically that $10,000 has lower purchasing power. Now, what does that mean? Think about your coffee. When you go out to get a cup of coffee, maybe a cappuccino, is it the same price as it was 30 years ago? Definitely not. And if it is, let me know your preferred coffee shop. But essentially, the money loses value through the years. Now, if you would have invested that same $10,000 in the S&P 500 index for those 30 years ending in 2022, you would have grown it to over $158,000. You know, I'd love to hear what people would do with that extra $158,000. But clearly, this can significantly grow your money over time and makes it a very powerful tool. Now, again, that is just a very quick crash course into the power of investing. I encourage you to continue learning more. But for now, we're going to cover retirement income. Now, people get their retirement income from many different sources. And some of the most popular include employer-sponsored retirement accounts and independent retirement accounts. One thing I want to discuss is that many people believe Social Security will be enough to sustain them through 20 years of retirement. But the average Social Security check is about $1,500. And I don't know about you, but here in Los Angeles, that would just about cover my portion of rent. So it is critical to have a plan so that we have options. Now, I do think it's important to understand some keywords. I'm sure, hopefully you've been taking notes of words and key terms that you want to review later. But there are a few terms that it is important to get on the same page about, since a lot of times there is financial jargon. Seems like we make it more difficult to understand than it needs to be. The contributions, that's the money you put into an account. The money you take out of an account would be a distribution or a withdrawal. You can see vesting. This is a process where if your company, your employer matches your contributions, and we'll talk a little bit about this in a couple of slides. If they match, that fund or that money needs to vest. So it takes a certain amount of time, usually years, for that money to become yours. So when we contribute to our retirement accounts, we put our contributions in, and sometimes our employer puts contributions in. What you put in is always yours. So if you leave the company, in 30 days, that's your money. If you leave the company before the employer contributions have vested, then you do not get to take that money with you. So important to keep in mind, especially if you're approaching the vesting period and looking for a job. Tax-free growth, now that's the earnings on your contributions are growing and not taxed. We talked about that with the HSA. Tax deferred growth, deferred, your taxes wait. Your contributions grow without being taxed until you withdraw your money. Tax deductible, we talked about this with the HSA too. That's when something reduces the amount of your taxable income. This applies to a 401k. So for example, if I make $100,000 and I contribute $10,000 to my 401k, 100,000 minus 10,000, that leaves me 90,000 of taxable income. So I don't have to pay taxes on what I contributed to my 401k. And then required minimum distributions, or RMDs, that's the minimum amount you need to withdraw when you turn 59 and a half in certain retirement accounts. Now, taxes are very complicated. One way I keep this straight is remembering that in general, Uncle Sam or the US government will get their taxes. So if you don't pay your taxes up front, you can expect to pay them when you withdraw. And vice versa, if you pay your taxes up front, you can expect to withdraw tax-free. So a little rule of thumb that can help keep it straight. But that leads us into the retirement accounts, starting with employer sponsored. Now, we're going to take a look at the 401k and 403b. A lot of information on this slide. Do not worry, you will have access to these slides. Oleg will make sure those get into your inbox, but you can see a lot of the basic information about these accounts. There is still a lot more to them. The main difference is who is eligible for each of these. So for the 401k, that's available for employees of private sector companies, whereas the 403bs are sometimes available for tax-exempt organizations. Again, public schools, nonprofits. For both accounts, the maximum contribution is $23,000 for the year 2024. Now, that also changes based on the year, so you may be able to save more in the following year, depending on what the government decides. You'll also see that if you're over the age of 50, you can contribute an additional $7,500. That's what's called a catch-up contribution and is helping encourage older workers to save more as they approach retirement. You know, they're in the home stretch, they need to save more as much as possible. Now, the money we contribute to these accounts are made pre-tax, meaning your taxable income decreases. But again, we know Uncle Sam will get his taxes so we will pay the taxes when we withdraw during retirement. Now, one of the major benefits of these plans, more so the 401k, is that employers or companies can provide a contribution match. And I gave you a sneak peek. That contribution match can help you reach your goals. So let's take a moment to discuss how to take advantage of this feature. Now, first off, you'll have to find out whether your employer offers a match to your retirement contributions. And if they do, it is essentially free money. Again, as long as the contributions vest, they go through that vesting period, maybe 2 or 3 years of employment, you will be able to take home that money. And there may be different ways that a company provides a match, such as providing $1 for every dollar you contribute, or they may match 5% of your salary. In the 5% match, in that case, it makes sense for an employee to contribute at least 5% to take advantage of the entire match. So for example, if an employee only contributes 3%, the employer only matches 3%, leaving that 2% on the table. So on the screen here, you can see the basic illustration of an employee contributing 10% of their $100,000 salary. With the 5% employer match, you can see that the total contribution at the end of the year would be $15,000. That's 1/3 of the total being directly from the employer and not the employee's pocket. So once again, this might not be in your salary, right? This $5,000 is not necessarily in the employee's salary, but it is the money, the added benefit that they're receiving by taking advantage of this retirement plan and feature. So, and again, just to really hit the vesting idea home, if you were to leave a company before the vesting period, you hit the vesting period, you would take along the $10,000 that you contributed, but the $5,000 employee contribution would not go home with you or not stay in your retirement account. So helpful to know. But even if you don't have access to an employer sponsored retirement plan, you have options. So you have options with the independent retirement accounts, commonly known as IRA. I know my dad pronounces it IRA. So with that, whatever boat you're in, the main difference of the Roth IRA and traditional IRA is tax treatment. So for Roth IRAs, you get a tax break later because you pay taxes up front. For traditional IRAs, you get a tax break now because you pay taxes later in the future when you withdraw funds. Again, another example of Uncle Sam always getting his taxes. So with that in mind, that's why we see there are no RMDs or required minimum distributions for Roth. And the government doesn't make you withdraw from your Roth account when you hit a certain age because they already have the taxes for that money. So on the other hand, if you're invested in a traditional IRA and you've contributed with pre-tax dollars, they require you to withdraw at a certain age so that they can finally collect those taxes. So that's another helpful way to kind of understand the difference. Another difference you'll see is the income eligibility. Anyone with earned income can contribute to a traditional IRA regardless of how much money they make. But a Roth IRA is only available to workers who make under a certain threshold. So you would want to double check whether that applies to you. The contribution limit is a little less, maybe significantly less than what a 401k or a 403b can contribute, but there is still a contribution, a catch-up contribution for workers over the age of 50. You can see that's 1,000 additional dollars. Now, in the event that we have attendees who might work for small businesses or are self-employed, we also want to highlight the SEP IRA and Simple IRA. If you haven't learned by now, that financial industry loves acronyms. SEP stands for Simplified Employee Pension, and Simple stands for Savings Incentive Match Plan for Employees. You'll see here highlighted in purple, the main difference with these two retirement accounts are which workers are eligible and how much they can contribute. One major difference with SEP IRAs, that's different than any other account we've seen, is that only the employer can contribute. So the employee cannot make a contribution in the SEP IRA. Now, they would be able to contribute $69,000 or 25% of your overall compensation, whichever is less. So again, for someone who's making $100,000, 25% is $25,000. That would be the contribution allowed in a SEP, since it is the lower of the two. On the other side, on the right-hand side of our screen, simple IRAs are available to workers employed at businesses with less than 100 employees. The contribution limits for the employee contributions, pretty straightforward. But if there is an option for an employer match, it's based on two different formulas. So wrapping up here, since both of our accounts, SEP and Simple, have tax deferred growth, meaning the taxes are waiting, we see that both have RMDs, so the taxes can be paid upon withdrawing in retirement. So I'll take a deep breath here, and I hope all of you will as well. I know this is a lot of information in a relatively short amount of time. Again, there's even more information about retirement accounts, different saving options, and different benefits. My hope is that you feel more comfortable or even just more curious about certain keywords and terms so that you can enjoy additional perks of workplace benefits. And most importantly, that you can feel confident working toward a secure retirement. So I know this is the end of our conversation right now, but it's really the beginning of the conversation for workplace benefits and savings. So I'd encourage everyone to learn more about your specific retirement account options and benefits available to you at your company. As I said in the beginning, I am always honored to partner with the LA County Library and their excellent Work Ready program. Again, my name is Tiffany Dyson, and I will open it up for questions. Oleg, I'm curious what the Q&A in the chat looked like.
So in the chat, there was a lot of conversation. A lot of people asked whether they can get the slides after the program. And of course, I answered yes, because a PDF of your slides will be sent out in a follow-up email, I think either tomorrow morning or maybe even later today. I'm going to try to get that out to people very soon. And we talked about these slides were created on Canva, which is they're lovely slides and chock full of information. But now we've got a bunch of questions, and I really want to get to the questions. We have about 15 minutes for questions, so we're going to do our best to I'm going to try to lob them to you, and hopefully you can hit as many of them as possible. So the first question is, actually, did you want to just remove your slides? That way your video can just be on the screen. There we go. Oh yeah, make sure to have that there.
Thank you. Yeah, feel welcome to add me to LinkedIn. I try to share some resources throughout the year. So always happy to connect.
There we go. All right. So first, you mentioned the child stays on the parent's insurance until age 26. Does this mean all of age 26 is covered until the 27th birthday, or all of age 25 until somebody turns 26?
Yes, that's a great question, and I have a, like I said, lived experience through that. So typically the health insurance coverage, even though they are a company and they want to make their money, they're not going to leave you out to dry. So essentially, I got a letter in the mail telling me, your 26th birthday is coming up, and I had about a 30-day grace period of coverage so that I could go and find my new insurance. Fortunately, I was employed and I could, easily go to my HR department to use that qualifying life event and get set up with the employer health insurance. So again, there was no lapse in coverage. Now, if you delay and ignore the messaging, there may be an opportunity to, miss out on
Lapse.
coverage. So I would encourage you to prepare and plan so that doesn't happen.
So it's less than or equal to age 26. All right. Are reimbursements taxed as income? I think you talked about reimbursements during a part of the presentation.
Yeah, that's a great question. And I with all of this, I would definitely encourage you to do personal research as well, especially I'm sure we have a lot of mostly California people, but who knows? Um, from my understanding, yes, the entire amount of your tuition reimbursement is subject to income taxes. So within TurboTax, they would likely and that's TurboTax is my preferred, not sure what you use or if you have a tax professional, but there would be an opportunity to use that or input that amount into your taxes.
All right. And then professional development is a nice benefit, but how do you get them to actually let you use it?
Yes. So with professional development, it's kind of a broader category. Now we reviewed the um, tuition reimbursement, maybe development stipends, conferences and events. This is definitely dependent on how open your employer is to enhancing your professional development. I like to be optimistic and think, okay, every employer should be, happy to help, their employees fulfill professional goals. Um, I know certain people who work at places who don't have opportunities for, let's say, job shadowing, right? You go in, you do your work. I think the main thing is to ask, which again might not get you the answer you want or deserve, but it can it can be a form of professional development as well, right? Advocating for ourselves, you know, asking for what we are worth and what we deserve, that is a form of professional development. So if they don't say yes to the opportunities to the conference, at the very minimum, you are working on kind of the muscle memory of advocating for yourself and what you need. So that might not be the answer you are looking for, but hopefully can turn that kind of objection into an opportunity.
Thank you. So for the public service reimbursement or the loan repayment is working at a public school, does that count as public service?
So for the public service, do we know if it's the public service loan or, yeah, I think the loan. So from what I've researched, the public service loan forgiveness is eligible for certain employers. Like if you worked for LA USD, you may be able to, and I'll actually, I'm gonna type in LA USD service loan forgiveness. So if you type in LAUSD, Public Student Loan Forgiveness Program and options, you'll find a link that has complete details under their Human Resources Division. What I'm seeing here is that starting on May 1st, the US Department of Education has paused processing any forms for this, for the public service loan forgiveness and what's called a TEACH grants. Why that is, I'm not sure. It may be they are, way far behind on processing. But I would certainly look up whatever public school district you're in and learn more about the program options.
We have a comment in the chat that looks
Mhm.
very helpful.
Mhm.
It says the financial aid website has a server where you input the employer's code to see if it falls under the public server forgiveness.
That's awesome. That's
But yeah,
awesome.
it says, but yeah, yes, the Supreme Court has blocked student loan repayment forgiveness once again.
Yeah, it ebbs and flows, but just knowing where you can go and oh, like what was maybe let's highlight that comment again. What was the website?
So it's the financial aid website. I presume it's FAFSA.
Yeah.
I mean, that's what it was when I was in school. I'm sure it's the
Yeah,
same. Yeah,
FAFSA is still the
FAFSA.gov.
main federal
Hmm.
student aid website.
Hmm.
And they have a lot of good information. They will be more up to date than most places and most people. They even have,
I'm going to include that in the FAFSA, the URL to FAFSA, or the web address to FAFSA
yeah, yeah, and
in
they
the
have
follow-up email.
that's great. They have a link on their website that is public service loan forgiveness, which again looks like it's paused, and teacher loan forgiveness. So as it pertains to teachers, then
Somebody mentioned in the chat also studentaid.gov. I'm going to take a look and then I'll put the correct web address in the follow-up email. I really appreciate the folks answering the questions in the chat.
yeah,
That's very nice.
absolutely. And there's so many resources that are out there to learn more about how you can apply, right? Just like if you're a high school student looking to get a scholarship, there's thousands of resources available to you. You just have to go look.
Mm.
But we're excited to be able to follow up with you on that.
So next question, this question regards health insurance. What does health insurance reimbursement mean? Meaning if I start a job and they offer this, would I have to pay the full amount for health insurance and then be reimbursed? Also, how does this affect taxes?
Hmm, that is a good question. So if you have a health insurance reimbursement um arrangement, you might want to talk with the HR department. I do know that small businesses often offer this type of arrangement as kind of an added benefit. And I'm just reading like, how does health insurance?
Mm.
So essentially, health insurance reimbursement is not considered income. It's a way that employers they don't have to pay payroll taxes and employees don't have to recognize income tax. So it it goes straight to you. Again, you don't see it in your paycheck and they just pay it directly. Um, from what I understand, the taxes are a deduction.
So just to clarify, because I've never heard of this sort of arrangement. A lot of employers will just pay your health care and then you don't have to worry about it. But so this in this kind of situation, the benefit you get is that you have your own health insurance and then you submit the paperwork for the costs to your employer and then they will cover it.
Right, right. And
Mhm.
and if they're through an HSA as well, and this is probably a different question.
Mhm.
When you make a qualified payment using your funds from the HSA, a lot of HSA banks or the accounts that hold it will actually give you kind of like a debit card. And so if you're going to pay that copay or for some prescriptions or the deductible, you can use that card and it can come directly from your account. But that's, again, something that would be available to people on high deductible health plans. The health insurance
HSAs.
reimbursement is definitely a nuanced case.
So that's something that you would need to check with specific
Mhm.
HR departments just to make sure you have the exact details for that specific organization.
Yes, yes, but it is,
Mhm.
from what I understand, it is deductible.
And HSA's health savings account, just
HSA,
for
okay,
acronyms.
yes, so many.
Yeah. All right. I would like to know which companies can help with investment. I've been wanting to invest, but I don't know where to start. That's a really big question. That's like a whole nother presentation.
It is a whole nother question. And so I can share what I personally do, but I just emphasize that this is not, investment or tax advice. So essentially, you might have your money in your bank account, which, yeah, you have your credit cards and your debit cards. Now, that money is likely making like 1 penny, right? The interest rate is very, very small.
Mhm.
Now, personally, because I think it's relatively easy to use, I have the money that I want to invest, which is outside of my retirement accounts, which is something separate. The money that I want to invest is in a brokerage account. So you can type in like brokerage account and I'm sure you'll get a lot of sponsored ads for different companies. I use Fidelity. I think they have, a great system. They have a lot of education that I really appreciate. And so I've opened up a brokerage account. When I have money that I want to invest, it's in my Fidelity account. Some of my money that I'm kind of waiting on the sidelines is automatically invested in a money market fund, which has right now a higher percentage of interest that we're gaining because interest rates in general are high. And then I have the rest of the money invested in, some stocks, some, mutual funds, ETFs. But Fidelity, to make a long answer short, Fidelity is the company that I invest with. I'll say, Vanguard, Charles Schwab. Those are a couple other companies that you as a retail investor can open up an account with. But I'd encourage you to, again, do more research and learn kind of what platforms you like best.
All right, we've got just a couple of minutes, so we'll just do two more questions. All right, so first of all, FSA, dependent care expenses, can I pay for daycare?
Yes, so that I appreciate that question because that's something that we didn't go over, even though we did have the FSA, the flexible spending account up on the
Mhm.
screen. So there is a dependent care FSA that lets you use tax-free dollars to pay for both childcare, like daycare, and even elder care. So it is really helpful for maybe people in the sandwich generation paying, caring for young ones and our, aging loved ones. So that can be a really, really great option, again, to take advantage of the tax-free money to make a payment, right? So as a kind of illustration, if let's just say in a crazy world, daycare was $100, $100 in if with tax-free, that would just be, I would pay my $100. If I don't use an FSA or dependent care FSA, I would spend the $100, but I would also be taxed kind of behind the scenes on that $100. So it ends up being more than $100. That's just to kind of clarify how the tax-free process works. But I appreciate you asking that question, and it's a great feature.
I know that we have more questions here, but we're out of time, so we'll just do one more question and then and then that we'll have to conclude for the day. So I apologize to all the folks who we couldn't answer your question, but we would have to be here for much, much longer. And I know that some people are watching this on their lunch break or, in during a specific time period for them. So anyhow, the question is, any thoughts on Cal Savers?
Great, that's a great question too. Now, and I do know, so Cal Savers for everyone, to get on the same page, it's California's dedicated retirement savings program that is really working to ensure that every single Californian has access to a workplace retirement savings account. So this is being updated all the time as government programs do. But essentially, the company is required to participate in Cal Savers if they have 5 or more employees and they don't have a sponsored retirement plan. So it is getting more people invested and getting them thinking about saving for retirement, which I think is a great thing, always. Another kind of great thing about it is that it is completely voluntary. So sometimes well, and I do think Cal Savers is primarily an automatic enrollment. So if your company has it, you would automatically be enrolled and you would just have the option to opt out. So, trying to think of like why I would opt out. I don't have.
If you already have something else going on with your retirement or
Yeah, maybe if you're really diligent about, saving and investing in other areas, but the kind of counter to that would be you're not benefiting from the tax
mm,
advantages. So that would be something to be mindful about.
yeah,
And Cal Savers, I'm sure they have webinars and a lot of information. Like if for the person who asked this question or anyone who's curious about learning more, I would definitely take a look at Cal Savers or even the Office of the Treasurer. Fiona Ma always puts on really great educational webinars that may be more specific to their programs.
mhm. Yeah, I posted the CalSavers link in the chat, and I'm going to put it in the follow-up email as well. I looked at the treasurer part of it. That's mostly for employers, it seems. So I'll
Mhm.
put the direct link to CalSavers in the follow-up email so people can check it out. Well, Tiffany, thank you so much for distilling this complex web of information into something that we can take a bite out of. And of course, the presentation that you put together so kindly for us will be shared with the attendees. And I'm going to put a link to the post-event survey into the chat. So if you folks out there have a moment, literally less than 2 minutes, if you could please fill out the post-event survey, very much appreciated, with feedback about this program and also topics you'd like us to cover in the future. I definitely read every survey response. Sometimes I respond to the survey responses. So very much appreciated. And once again, thank you, Tiffany, and thank you to the folks out there for being here, sticking with us, asking your great questions. And we will see you next time.
Awesome. Thank you so much, everyone.